Pause rates any second now. I'll do the screen, do all the talking. Alright, there you go. 158 points down for the Nifty. It's a gap down start and the market breadth is completely dented. So there is only red and only red on the screen, at least in benchmark indices. For the Nifty also, the same story continues. For the mid cap index also, the same story continues. So there is hardly any green on my screen, with the exception of an Adani green. Maybe it's the word green which is looking strong for Adani green, but Adani green is the only green which I can see on my screen. Now you've got NBCC which is up by 1%, just a coincidence. Yes Bank is down by 2%. You don't have any large stocks which have seen a lot of collateral damage, but not a good start, guys. Not a good start.
Let's check in on what Tata Motors is up to. You know, the subsidiary Tata Tech has filed for a DRHP. Tata Motors marginally higher, 0.5% in the green. So giving Adani green, that company. Tata Motors 534 is where that stock is. There's also MGL. Brokerage is also pretty positive post the management commentary on Unison acquisition which has come in. There is Zydus Life as well, which has filed a final US FDA nod for erythromycin tablets. So that's another stock which is in focus, holding up 0.7%. And I'm focusing on the positive news right now. We'll come to the losers in just a bit. Wipro as well. The Menzies Aviation has selected company to transform its air cargo services. So a sizable order coming in there. But I'm not quite sure whether Wipro will be seeing any green this morning or not. That stock will just come off your screens. Yeah, predictably so. It's down 0.7%. IRB Infra, a bit of a mixed picture when it comes to the Feb toll collections. Year on year, of course, they're looking up, but month on month, there's a downtick of 6%. Absolutely flat for IRB as we speak right now. By the way, yesterday was the Maharashtra budget, and today is going to be the Punjab state budget. And Maharashtra budget is proposed almost 5,000 EV buses. So that's quite a bit of push actually coming in. So maybe the likes of an Electra, JBM Auto, etc., something that you can look out for. Look at that gap up on Electra Green Tech. It's holding up 6% right now. And JBM Auto, which is seeing a gap up of about 3.5% in an otherwise weak market. But that said, it is a gap down start. Kunal, we've now slipped below the 200 DMA. What next?
Yeah, I think there should be more selling pressure, at least the adjustment for the risk in the last 3 days, because there was some sort of positivity brewing into the indices as well as in the sentiment. So that risk should be tapered off. So I think the first couple of hours till at least 11:30, 12 noon is where the risk adjustment generally happens. So I would probably expect the markets to remain under pressure for the first couple of hours, and then we'll take a call whether there's any major kind of a trades which is emerging as a contra buy on the index as well as on stocks. But the initial stock which I would look to sell would be Asian Paints, the stock showing an incredible amount of indicators getting into an overbought territory. So would suggest a sell as well as go into a shorting over here for Asian Paints.
Yeah, we're just aligning ourselves with the global mood this morning. And I'm just looking at the constituents from within the Nifty Bank. That's where you're seeing the sharpest signs of pain. Look at RBL Bank. That's down 3% right now. Big boys like ICICI Bank are cracking 2% as we speak. Financials like Bajaj Finance, which in any case has been a rank underperformer of late, that's fallen even further. There's, of course, PNB, Kotak Bank, HDFC Bank as well, which is lower by about 1.6%. Federal Bank, BOB, Bandhan, Axis. You can pick up any bank from within the sector, and that's all falling down. Besides that, of course, there's also Apollo Hospitals, Hero MotoCorp, Reliance, which after that 2.25% crack yesterday, it's fallen another 1.5% right now. So 23.39, just about defending that 23 mark literally for Reliance Industries. iShares is down, technology is down, led by Infosys, and then of course there's L&T as well. And the Adani Group names, by the way, are getting quite whacked in this weak market. So Adani Enterprises falls another 3.5%. And I think besides Adani Green, like Nikunj pointed out, it's all a sea of red. But Rudra, what are the first trades that you're executing looking at this gap down?
See, for me, two things. One is, if you are an aggressive trader, use this opportunity of fall in banks to buy good banks. We are talking about SVC yesterday in America, but look at even top private banks of America. They have fallen, but not like what 60% fall what you saw yesterday in SVC. So what I'm trying to tell is buy quality stocks like HDFC Bank on this dip. You have strong support at 1580. Look at even ICICI Bank after this fall. From PSU banks, look at Canara Bank, look at SBI. I'm not advocating buying an Yes Bank. I'm not telling you to buy either even RBL Bank or banks such as these. Look at HDFC Bank, look at Canara Bank, look at SBI. Use this gap down as a buying opportunity with strict stop loss. For me today, if I have to pick a trade based on what I see on screen, Bharti Airtel is outperforming in a market like today, and it is a consecutive 2 days of outperformance. I've in fact bought Bharti Airtel now at open, looking at targets of 810. That was also my morning recommendation. Stock is outperforming, so I have a buy call on Bharti Airtel.
Manishi Chaudhary joins us now. Let's understand what he makes of the market dynamics, where he feels markets are headed. Manishi, we were in a range. We are in a range. Do you think we are likely to remain in a range?
It's all about the Fed now. And we will get jobs report evening. It'll quite likely strengthen this whole higher for longer attitude that the market has. We will get the CPI report, particularly, I think that's on Monday, and in particular, what to watch out for would be the core services CPI that comes out of the US. And we believe that all these data points would actually strengthen the currently prevailing wisdom that on 22nd March, we will have a 50 basis points hike. Remember that even a couple of weeks ago, that expectation was of 25 basis points. Today, the probability attached to a 50 basis points hike is possibly about 60 to 65%. So there's been a profound shift in this, interest rate cycle outlook. And the market is now currently convinced that it'll be not just a higher for longer kind of scenario, but possibly a much higher for much longer scenario. So this is something the market is trying to come to terms with. What you saw overnight in the United States is an indirect effect of that. When you have a spike in rates, obviously that leads to these basically credit events, as we call them. Now, in Asia or in India, we don't really foresee any of these major credit events. There are highly leveraged companies, no doubt. But on an average, the extent of leverage in Indian corporates has declined to just about 50%, 0.5 average debt to equity ratio. So I think, broadly, the Indian corporate universe is relatively safe, but there's no escape in the near term from what's happening outside India.
Do just sit tight, don't do anything, or it's time to raise cash, because what you've outlined is a plethora of bad news which could be hitting the market now.
Unfortunately, good. And, we will have to sort of grin and bear with a situation where the rates go up quite considerably compared to what we were thinking even about 3 or 4 weeks ago. The rates would stay there for much longer. Now, it also, of course, is giving rise to a situation where some good stocks are being hammered down. Consequently, there are some stocks within the private banking sector universe in India that has come down quite sharply. There are some sectors within India which are actually bucking the trend in rest of Asia. In rest of Asia, we're seeing the exporters are suffering because of the likely demand contraction in the developed markets. But if you look at the classic exporters in India, like IT services, their deal wins are quite.
Seem to have snapped that link. Just going to get back to Manishi in just a second from now. But just looking at the kind of plunge that you're seeing in the markets, we're down 215 points now for the Nifty futures. So we've broken that 200 DMA as well, sitting sub the 17,400 mark, 17,393 on the Nifty spot, and just about defending that on the futures. Adani Enterprises down 4.5%. India Mart has fallen 3.5%. We were talking about the weakness in banks, which is led by RBL Bank within the mid caps and ICICI Bank amongst the larger ones. 3.25% lower for RBL Bank. Idea is down 3%, and FSL as well, which has been falling off late quite a fair bit. That's down another 3% as we speak. I'm just going to quickly draw up the list of where is it that you're seeing some fresh shorts as well. So besides the list that I talked about, there's Coforge, there's Bajaj Finance, there's SBI Cards, Tata Chemicals, IndusInd Bank, HDFC Bank, Canfin Homes, Bandhan Bank. So it's largely banks which are really taking it on the chin. While we do try and get back with Manishi, let's also hear it out from Rajiv Jain from GQG. And he says stocks like NTPC and SBI are currently offering robust earnings visibility. That's the word coming in from him. He's, remember, invested 15,000 crore rupees in the Adani Group stocks. Let's hear out his opinion on some of the others.
If you were sitting here in 2005, SBI used to trade at 15-20% premium for foreigners. Foreigners couldn't buy at the market, by the way, right? So like everything else in markets, that is the sentiment is cyclical, and I think in our opinion it'll change. But the good news is the way we think about it is that our job is to get earnings growth and the dividend combination right. If the valuations increase, that's wonderful. But even if they don't increase, we should be able to compound at double digits. So that's how we think about it. So we don't wait and hope for others to agree with our view. You know, maybe they never agree. But in the meantime, the earnings growth plus dividend gets us to double digits. We are happy owners.
Rajiv always insisted that market price is a function of EPS into PE. PE is perception, EPS is growth. In Indian market, where do you think there is scope for P expansion as well as EPS expansion, and where do you think there is scope of only EPS expansion and no P expansion?
Yeah, I think the second bucket you'll get the companies like Nestle's of this world. I think these companies will continue to deliver, but Nestle, I don't know, 70, 75 times, something like that earnings. I've kind of lost track. And Nestle, as you know, was a large position for a long time. So could they be derated as the earnings growth shifts away to other areas? Because you have to look at one aspect. Over the last decade or so, globally, earnings growth was on a slower side. So a lot of these defensive type businesses were re-rated because investors look for growth, including us, right? So growth was scarce. Now, and interest rates were low. So you know, you got a bubble in tech, not so much in India, but elsewhere. On the first bucket, look, I think we talked about some of those. I mean, State Bank of India, why does they have to sell at 8 times earnings? Because I think they'll grow at mid-teens plus earnings. So could they deliver those returns? If they keep delivering those returns, could the multiples be higher? I think so. In fact, even some of the private sector banks have recently been derated too. So in fact, I would argue that most of the names that we own have a reasonable chance of multiple expansion. But if it doesn't happen, it's not the end of the world.
What makes you so bullish on State Bank of India? I've spoken about State Bank of India at least 4 or 5 times in this conversation. Are you not worried about, and again, I'm being a devil's advocate here. My personal view on State Bank of India is very bullish, but here I'm asking a question as a commentator that their return ratios are not the best in the industry. Their ROA is just about 1%. Private banks in India pretty much have better return ratios than SBI.
Mm-hmm.
So what makes you so bullish?
I think, yeah, but I think if you look at the corporate side, besides ICICI, I think they're probably one of the better positions on the corporate book. But I think the question always is what is discounted in the price. So yes, I agree the return ratio is not as good, but who would be able to grow earnings at mid-teens plus in a much more consistent manner, and what the market is not anticipating? I think that's where we believe the rubber meets the road in terms of the gap between what I say perception and reality. So at 8 times earnings, if you take a 5-year view and they grow earnings at, let's say, mid-teens plus, it becomes a fairly attractive proposition. Especially because they have a much better. I mean, there are a lot of private sector banks who have really no experience in lending to the corporates, by the way. But that was a strength for them. But could that become a weakness going forward? If you look at the profitability expectations that these companies had, they are being cut pretty aggressively. And the reason is some of these businesses have really no barriers to entry. So the growth is fine, but is this sustainable long-term growth? And one of the things we look for all the time is, what are the barriers to entry? Can somebody else replicate those businesses? And at this point, there's no evidence that these are truly businesses that have any pricing power or sort of barriers which can make it difficult for others to come in. So the valuations are still on expensive side for what they're delivering. But I mean, I'm not saying people can't make money. As they say, there are 100 ways to heaven. You just need to find one. But from our cup of tea, they're just better fishes to fry in some of the other areas.
Mr. Jain, every market follows a cycle, and there's always a theme which is at play. So in 2000, it was TMT. Then it was infra between 2003 and 2008. Then good old consumer stocks, which you bought aggressively, the HULs and the Nestles of the world. Can I say that looking at your portfolio positioning in India, you are betting on the infrastructure boom for next 3 to 5 years?
Look, I think we are pretty bullish on that, because I think there are a lot of things in place, because the execution under this administration has been strong, which is important here. And the second part is that we saw the similar in China in that stage of development where the infra spend actually took off in a big way almost 24, 25 years ago. So we feel that India might be in a similar sort of setup where the earnings growth could accelerate. The problem is there are only few and far names in the infra side, right? Quality names, they're not dime a dozen. Like banks, there are a lot of names you can play. If you look at consumer staples, there are a lot of names, but infra side there's a little bit dearth of those. I mean, the ABV seems too expensive, and people kind of gravitate toward those. But I agree that I think if I take a 5+ year view, which is what we take, none of what we do is sort of on a short-term basis. I think infra, we feel, is a lot better place to be. And in general, foreign investors are totally missing in that space, by the way. IT services, pharma, or especially consumer staples is kind of what I call comfort zone.
Why have you avoided IT companies? I mean, these companies are now doing buybacks, they're doing dividend. Yes, growth is something which changes the terminal value, but ultimately growth is something which these companies are still growing between 8 to 10%.
Yeah, I mean, as I said, I think if I can buy 15% plus growth, why would I buy 8-10%?
Fair point.
And by the way, another mini crisis. If you remember, Infosys, we actually bought quite a bit. There was a whistleblower crisis in Infosys in 2019, not that long ago, right? Down 30% in a matter of days. Hell was breaking loose, and I don't think so many people remember that. So that's these mini crises happen from time to time.
What else is on Rajiv Jain's radar? I'm looking at his excitement and the zing in his voice and his commitment towards India. I'm sure he will not just at Adani.
Yeah, so I think look, we run concentrated portfolios. So we need sort of larger cap side. We can't really operate in mid and small. There are a lot of interesting stuff which we sort of look once in a while, but I think from a larger cap size, these are some of the names that we talked about, and I think our view is that any meaningful pullbacks in some of these kind of names, we probably would be happy buyers. I mean, obviously it depends on the relative opportunity other places. So I mean, as a matter of fact, if you look at the reopening excitement in China, we haven't really participated at all. In fact, I was wondering why people getting excited about reopening. I mean, nobody expected China to be closed for 5 years, did they? So I mean, like, why is reopening exciting at all? I think the longer term EPS growth story in some of these kind of names is pretty powerful. But you also have to look at a disconnect, right? So and I think the disconnect is some of the areas that I talked about.
As promised, here's our big mega exclusive. The CFO of HDFC Bank, the first television interview ever on where the bank is headed, CASA ratios, retail growth, and if the merger goes through immediately, what happens to the return ratios now that HDFC Limited has raised capital.
The beauty of this place is that the macro is that the consumer credit is very low in the economy, right? When you have the consumer credit penetration 20 to 30%, 20-25%, that is, so you have a long runway for consumer credit to pick up, right? people aspirations have only gone up. People aspirations haven't come down. So if one has to be operating like a Western world in times to come, there's a long way to go. This has to double, triple to be at that kind of a level from a consumer credit penetration. So there's a long way from that sense.
I'm surprised that, I mean, there's also a point that your entity is being able to do it very well. But if you look deeper into the system, there are consumer durable companies which are telling us that some demand has, maybe you are mining your clients and your customers very well for the penetration part. I want to understand with you, there is a thought in the market about your bank, which has seen phenomenal decades of 20% plus compounding. And now the numbers show that at least the business growth on the top line front is kind of hovering around the 18% kind of a number. Whereas your NIM growth is very healthy, 24%, and many other parameters are upwards of 20%. So are we now seeing some moderation, and for foreseeable future, that's the new normal we are talking about?
See, if you go back, you have to go back in history to see what is the kind of rate of growth that we have experienced. You can look at any block of a 3 years or a 5 year blocks, right? A year or a quarter wouldn't tell you a trend, but if you look for a longer period, say 2012 to 17 as a 5 year block, 2.3, 2.4 times, essentially high teens to 20. That's the rate of growth, right? Assets or deposits. So you go back to 17 to 22, another block of 5 years, say 2.3, 2.4 times, 18, 20%. Or if you look at a recent time period of a year or so, this is a similar type of a 19, 20% type of growth. So that's the kind of, the velocity at which we are moving currently is faster than the velocity at which we were moving when we were 7 years, 8 years ago. So the larger we have got, the faster our velocity is. So
you will say that the best way to analyze the growth and velocity is actually look at a 5 year picture, not a yearly picture. Perhaps they will mask a lot of growth there.
Yearly is important, but over a longer period is where you deliver a change, deliver the difference.
Okay. So before I come on the retail part of the loan book, I want to understand how is the corporate end of the loan book behaving in terms of their behavior towards fresh credit, be it your SME kind of book, rural book, and of course the corporates. Because the fact of the matter is that rates in the system have edged higher, and from now also it likely to edge higher. So what kind of conversations are you having?
See, the larger the corporates, they come with the rate view, because professionally managed money managers who are there in the corporates, so they have quite a view of where the market is heading, the rates are heading, and so there's intense discussions that will happen in terms of the credit. But working capital is something, as I said, is inevitable and people have to finance. And from a project financing, it takes time, over a period of a longer term it comes. But good demand on that front, and people, it is not as interest rate sensitive from a working capital credit offtake, because ability to pass on is important, and that happens at both the SME level as well as on the wholesale level. People are able to pass it on. So that's, and then when they pass it on, does it impact the consumer spending at the end? It is reflected in the price of the goods and services at the end. Is it reflected there? It is. Does it matter? Does it matter to the overall economic growth? It doesn't. India is a high interest rate country for most part, right? Operating at a 6% to 8% kind of an interest rate is not something that is new in the country. Over a longer period of time, that's something we have seen that. And over this kind of period during those interest rate regime, the growth rate has also been very robust.
Sure.
And so that's part of how the economy has been functioning very well.
You have a very large part of your loan book now on the semi-urban and rural side as well. And there's again and again this argument coming on the table that there's a K-shaped recovery in the economy. Perhaps the lower end, inflation and higher rates both have been pressurizing the lower end of the customer or consumer. What are your thoughts on rural and semi-urban smaller ticket?
Yeah. So it is absolutely right that the K-shaped recovery is something that is visible and one sees that. but our banking customer target segment is above certain customer segment level. So we are not experiencing directly that particular segment which is impacted. It is true that inflation, disposable incomes are less at the lower levels. So that is part of the impact which is there. And coming out of the COVID, the most impacted customer segment from COVID was that segment, where the jobs were less, or daily earners or the weekly earners, so the impacted people who are there. So now coming out of that, whereas even in the semi-urban and rural that you alluded to, where 60% of the country is, our target segment is not all of that 60% of that rural India which is there. We are interested in the top 20-30% of that 60%. That is our target segment, which means the top end of that segment in the rural, semi-urban and rural, where they continue to have good disposable incomes and cash flows.
So we saw that in the quarter gone by, your interest income, there was a 13-quarter high kind of growth. And now people are also, though a lot of shareholders who have logged in because there was a very long wait also, the stock did not do very well in numbers. So people who are patient are getting rewarded now. But they're also kind of little worried, can this growth rate sustain? You see any reason to of that question or worry arising, or up till now the visibility is that it may sustain?
See the visibility in terms of what I would, rather than look forward to say where it is, I will look backwards, is to say that as a bank we have consistently performed in terms of having a balance of various products across segments, right? That suits the products are there that suits the economic growth across various segments. Depending on whichever segment is growing, we use that product at that particular time. For example, 2020, 21, 22, when we clamped down on our retail offering due to credit concerns of what's happening in the market and we don't know, shrank there. But there were opportunities on the wholesale side, on the SME side, which we grew. So we have products across to use that and run. And as I mentioned earlier, the velocity at which we are growing, that is very important to look at. And we are positioning for, if anything, growth faster to capture the opportunities which are still enormously out there.
I read that you are aiming at 1,200, 1,300 kind of branches every year from here on. I want to understand from you, what are the current, so if you look at the book size of your branches overall, how much are legacy branches? How much are the branches which are newly opened, which will give you 2-3 years ahead the fruits later? And which are the ones which are turning, where the fruits are becoming ripe to be harvested?
Yeah. See, I'll tell you, out of our branches, little more than, call it about 60% of our branches are less than 10 years, right? Why is 10 such an important thing to think about, right? When a branch is opened, it takes, call it 2 years, 2.5 years to break even. Then it builds to a certain level in 5 years' time, right? Then between 5 and 10 years' time, it starts to bring in that multiplier effect. So it goes to 5 to 10 years, it goes to 3x of what it was in the first 5 years. So you have a 3 multiplier there. Once it gets past the 10 years, it gets to multiplier of 10. So the more the vintage of the branch, the better the penetration in that local base and the deposit base that it can bring in. So that's part of what, and the new branches that we are bringing in are filling that pipeline, as the 60% of the branches that are less than 10 years are progressing and moving in the scale up. We are trying to fill the front end so that this process continues for the next 5, 10, 20 years.
Sure. So you have enough visibility of raw material also, which is deposit base.
At the end of the day, our deposit market share is slightly under 10%. Long runway to go to get much more market share.
So while you're very cognizant of the fact that in India, as much of feet on ground strategy works, as much the focus on tech. And if we break down your tech into 2 parts, one is a lot of tech related offerings, the front end. There have been question marks raised on the back end to a certain extent. I mean, just last week also we did have outage for an hour or 2. How are you speedily moving? Because your data on the app downloads show very fast growth, but then these niggling issues are also erupting again and again. If you could help us.
On the front end technology, which is what you alluded to, people are looking at it, a lot of clicks or hits that happen. over a period of last few years, we have made significant changes and improvements and new technologies that have gone in. So think about the Smart Hub Vyapar, which is out there for the small merchants which are there. We have about 4 million merchants signed up in our merchant business. We are adding 80,000-90,000 per month right now into the Smart Hub Vyapar platform, which is significantly enhancing the value proposition for those merchants, right? So that's part of one that is happening, and it's happening very well at that level. Another kind of a front end is also the Customer Experience Hub, which is there. The Customer Experience Hub was launched 3-4 months ago, is receiving excellent accolades in terms of the customers' ability to solve what they want, an omni-channel experience so that customer doesn't need to repeat the things that they have been trying to, because it captures and it stores and it hands off to the next person very well, and across channel, a brand channel, a VRM channel, or a sales and relationship channel, and so on. So across channels, it is connected. And we are rolling it out to further towns and across various languages so that pan-India we cover through this Customer Experience Hub. That's another thing. The new PayZapp 2.0, is a one-of-a-kind that has been developed, and it is progressively getting rolled out now as we speak. We have enormous plans for that, and it's a kind of an application that is making a big deal of a difference. Progressive rollout is the strategy that we have followed on that, and it is going through that aspect of it. In the recent times, we have also introduced the Auto First program. Like if you think about 7 years ago, we had this 10-second personal loan. Yeah. Again, one of a kind. After 7 years, you hardly will see anywhere that it is so popular. It's quite popular with us. So this Auto Express, Auto First that we have is a 30-minute turnaround time, end-to-end digital auto loan. Right? So these are some of those on the front end. We have been doing these things. Now come to the back end. Right? Lot of things have been addressed from a resiliency, availability, and our ability to scale. Right? At the rate of growth that we are having, we need to have a natural process of scaling these things up, which it has served a lot of purpose and brought us to a good place on that front. The time has come, we need to go into the next generation. See, the legacy platforms in the banks generally are at least 5-10 years behind from a technology adoption point of view, right? For various reasons. Indian banks are global banks, behind in terms of technology adoption, which is what we are trying to leapfrog into the new age, right? New tools, and more important is to take this on the cloud, right? Sure. The legacy platforms are not cloud capable. Right? Now we're trying to get into new applications, so that means redoing our entire back end with a new age developing people with a mindset to enable. It's a 3-4 year journey. That module by module we want to take it into microservices, put it on containers, and take it to cloud. Sure. And again, from the cloud, a multi-cloud type of strategy, so that we are able to have redundancies even within cloud. So that's a long drawn. We are in the process of developing those.
Right. And lastly, I want to understand from you once again, Srini, we are progressing on the merger. We just got a nod also from the NCLT. Talk to us about, the strategy which the combined entity will like to exploit on the business front. Up till now, you have spoken a lot about liability-led strategy. How are the benefits of mortgage-led strategy also kick in? And when we start mining the customers on both the sides in the combined entity?
Yeah. No, very important. See, mortgage is an important product for a household, right? Now, when you have a mortgage product being given to a customer, the engagement time with an individual and typically with a family is 30 to 45 minutes. Okay. As opposed to another product which could be 2 minutes, 3 minutes, 5 minutes. This is a longer drawn, right? 30, 45 minutes. So you have the kind of an attention of the customer. So that at mortgage, and you get lots of documentation in the process of mortgage. And if you're able to give a mortgage, we are now trying to work in a process in which a savings account is a process that we want to have along with the mortgage product. So if you get a mortgage, you need to have a savings account with us. So you have that in a conjoint manner rather than go afterwards and get a savings account. So it's joined
So in
together.
layman terms, just to understand the scope of synergies, how many of your banking clients or account holders would be doing a lot of other business with entities outside? And if you must have estimated internally that how many of the mortgage clients or HDFC Limited would be doing the banking relationship outside? So if they could come together.
Yeah, that's part of the synergy opportunity. See, in our bank, we have mortgage penetration less than 2% of our customer base, very meager. And we see that more than 5% of our customer base have mortgages outside. That's because of the reach, because two organizations, HDFC Limited and HDFC Bank, distribution strength is different.
Sure.
And so thereby, people have gone somewhere else where closer to their home or closer to their place, and they've taken that. So part of the synergy opportunity is that. So we capture our customers' needs ourselves and not let it go out, right? That's one of the important. Then the other aspect of this is, as we give mortgages, giving a credit card should be an easier process to do, right? Because you are evaluating a person's credit for a mortgage, you need to get the credit card in the hand. So your card becomes the primary card for them to use, right? A consumer durable, most of the homes in India need consumer durable. It's not pre-fitted for most part, not in the common the middle class. So we are one of the largest financiers of that from a bank financing point of view. So we are making that also into a package offering where we give that. Right? A home necessitates protection, life protection, so that the family is protected and is able to live in the home if, God forbid, something were to happen. So we do have on the shelf a life protection, a general protection, and all of that. So these are all the products that are getting tuned to be offered with the mortgage as the fulcrum around which these products are getting in there. So these are the synergies that, and the last you asked about is HDFC Limited customers. Yes, about 70% of HDFC Limited customers do not have banking relationship with us. So we need their liability relationships here. So that's part of the synergy process that we are trying to tap into to see how we get them onboarded here.
No recovery in markets whatsoever, 1.5% down, almost 1.25% down for the market, and no recovery whatsoever. Asian markets have also not recovered, but the small and the mid-cap space is where the narrative, which was slightly upbeat, now is getting crushed. What about steel as a category? China is opening up, and if China opens up, could that lead to inflationary fears again? The government of India, a couple of months ago, did import a tax, export duty tax on steel because of the extraordinary jump in metal prices to curb inflation. Could that thought be coming back now that China has opened up? What about plans to divest some plants of SAIL and the residual stake in NMDC? What is the future for that? Let's discuss all that and much more with the Steel Secretary of India, Mr. Narendranath Sinha. Mr. Sinha, good morning. Thank you for joining us. Indeed a pleasure to have you on ET now. Mr. Sinha, allow me to take the clock back. And 2 quarters ago, the government had imposed an export duty on steel exports. And the thought was that global metal prices are going higher. It was imperative to control inflation. Now that steel prices are trending up higher and China demand is opening up, could government revisit the export tax on steel exports?
Not at this moment. We are monitoring the price situation, but we are not contemplating or thinking about imposing an export duty at this moment.
That comfort zone beyond which things could go from comfort to the discomfort zone. Is there an underlying price which would be in benchmark to decide that?
So there is no underlying price below which becomes uncomfortable for the government and leads to imposition of any measures. So that depends on various factors, and certainly those situations have not reached now. And how it moves, how it behaves is a thing of the future, and I can't contemplate any such situation happening right now.
I'm not speculating, sir, but I'm simply curious. When you say that you're monitoring the situation, what are the variables which you're monitoring, which you right now think are in comfortable zone, but if those variables, whether it is demand, price, or inflation, if they change, you will be forced to revisit it. I mean, I'm just trying to understand the variables which you monitor.
We monitor the prices of input materials. We monitor the prices of the products in different categories. And I mean, although they have risen somewhat over their lowest levels, which reached about 4 to 5 months ago, but the situation has not reached such a level where one could contemplate any such measures which were taken in the past about 3 quarters ago.
Sina, we must say that's a lot of homework that goes into monitoring all these key parameters. But tell us what happens to exports at large then, because although India became a net importer of steel because of the imposition of export duty in the first half of FY23, exports have started rising yet again. And, since India has the capacity and ability to export, given its positioning in the global markets, are you at the ministry working on ramping up exports further?
See, it depends on various factors, including the demand in other countries as well. So export market. So while Indian demand itself is quite strong, and this year the demand itself has risen about 12% or so. If you see the export figures of this year, they were about 5.9 million tons. But we should also keep in mind that the export figures would have come down because the export duty was in place from May to November onward, May till November. So that would have been a dampening factor. Now that those duties have been removed, so I guess all those impeding factors to exports have been removed, and it depends on the demand situation elsewhere, the price situation in the world markets, and the India's own steel makers' competitive position vis-a-vis them. So I guess the situation is somewhat reasonable for the exporters, but let's see how it moves, because there are developments in other markets. For example, Turkey, there's would be a large-scale reconstruction effort, and I would tend to assume that Indian steel makers would also be craving for a pie of that kind of a demand.
Oh yes, after those earthquakes, surely. But you touched upon a very, very pertinent point. Perhaps you would be best positioned to give us an insight on how global demand is. Because at a time when you have growth concerns and economies slowing down across Europe as well as US in particular, but at the same time China now opening up, what can you tell us about global demand at this point?
If you see the World Steel Association forecast, they forecast about 1% growth in demand in the FY24. And as far as the demand in certain key countries are concerned, for example, taking China, its government has announced that they intend to have 5% rate of growth in the calendar year 23, as compared to 3% that they achieved. If we see US, the Q3 growth rate is about 3.4% as compared to Q2, which was about 0.4% or so. Elsewhere, people are expecting recoveries, but not of very significant order. So I guess in certain key countries where the demand might come through the efforts of reconstruction, elsewhere, apart from China, the market is almost either flat or growing very slowly. So, I mean, that kind of a demand push from the global demand situation, we don't see much.
That's quite interesting and gives us great insight, Mr. Sinha. Thank you so much for that. But, I have to talk about divestment as well. The government, which currently holds 60.8% in NMDC, intends to sell 50.8% stake in the company. We believe the government has already received multiple expression of interest for this stake sale. What can you tell us about it? What is the current update?
So the position of the government with regard to the NMDC is quite clear. It's not divesting anything from the NMDC stake. We are, of course, going for the strategic divestment of the Nagarnar Steel Limited, which has been demerged from the NMDC now. So that's the only thing on the offer as far as the NMDC is concerned. We are, of course, for the strategic divestment of the RINL as well as the FSNL, Ferrous Scrap Nigam Limited.
So in terms of also another update, sir, some plants of sale. Now there is an intention that Government of India has indicated that they are looking at selling few non-viable plants of sale. What's the update on that?
As far as the Visvesvaraya iron and steel plant was concerned, we had taken out expression of interest and no interest came. So the DIPAM has indicated that the effort should be taken for its closure and the process is on. As far as the alloy steel plant is concerned, the divestment efforts were made and now those didn't come to a conclusion. So the Steel Authority of India itself has been asked to look for different options. We are also moving forward towards divestment of disinvestment in the Salem steel plant, but that is still underway and it will take some time before we come to a conclusion of the process.
We at our end also, Mr. Nath, have been speaking with a whole host of analysts and, talking about the sale disinvestment. And most of them believe that, there is no headroom left for incremental volume growth in sale until the company actually goes for large scale capex. Are you looking at that? Are you exploring that opportunity to make sale more viable for disinvestment then?
We are not looking at the disinvestment in the Steel Authority of India Limited. In fact, we are looking forward for capex, and as per a preliminary exercise conducted, we could look at capex growth of about 15 to 16 million tons in about 7 to 8, 10 years time.
Proposed capacity for sale could be, sir, in terms of millions per ton in next 5 years?
Next 5 years, we should see something like about 25 or so.
And what is the planned capex for Steel Authority of India?
Planned capex is the earlier capex cycle has come to an end, and we are looking towards enhancing its capacity to about 35 million tons by about 7 to 8 years, I said, by about 31 or so.
Mr. Sinha, I'm sorry if this is sounding like a disinvestment calendar that we are trying to dig out, but we also would like to know about Rashtriya Ispat Nigam Limited, RINL, and as to what is the centre's plan when it comes to that disinvestment.
We are on course.
So have you already received expressions of interest, and are they looking
Those,
viable?
those documents are yet to issue, but many players have expressed their interest in acquiring those stakes. And it's a very interesting place. The plant is a solar-based plant. It has a significant amount of land holding. It also has a place for expansion. So all in all, it's a place which would be quite conducive to raising its capacity if the investor is ready to invest and could potentially raise the capacity of the plant to about 20 million ton or so. And therefore, it's a great place for making investment for any investor who comes forward.
Mr. Sinha, there is always this whole debate about the availability of coal. First availability, and then second accessibility, and then availability, accessibility, and then quality. These are long-term challenges. How do you think they are getting addressed? Because every time when we speak to SAIL or some of the private players, they are in a sense saying that, look, we see that steel demand going higher, but unfortunately it's the availability and dependence on imported coal which is in a sense crippling the growth of the sector.
I mean, we have to accept the reality that the Indian coal stocks and reserves are not such that they would be in a position to meet the demand of the entire steel production that might come through in about 10 years' time. Even now, we are importing about 90% of the coal from Australia and some other countries. Now, there is a mission coal which has been announced by the Ministry of Coal, and in this, not only the coking coal production from the mines of the Bharat Coking Coal Limited and the Central Coalfield Limited of the Coal India Limited is being asked to be increased, but additional washery capacities are also being set up. For example, Coal India intends to raise its washery capacity from 12 million tons now to about 45 million tons. The Steel Authority of India would also be raising its coal washing capacity from about 2 million tons to about 6 million tons. Tata Steel would also be raising its coal washery capacity to about 10 million tons. So the efforts are underway to utilize whatever coal reserves could be employed from the stock of available in the Indian mines. But the fact would remain, considering the demand that will come up on account of the enhancements in capacities and the need to feed the existing plants. We would largely be dependent on the imports. The efforts are now being on way or underway, which the sources of coal need to be diversified. And we are looking at different options that are available to the country. Of course, the dependence on coal could come down provided we make a switch to DRI, hydrogen-based DRI, and the Government of India has launched the National Green Hydrogen Mission. So if that mission is able to supply significant volumes of hydrogen at prices which are affordable to the steel makers, I guess that would bring down the dependence on the coal and imported coal to that extent down. But it's a medium range thing rather than a short term thing, and we'll till that time we'll need to be working towards the measures that I mentioned, diversification of sources of import and getting additional capacities through the Coal India Limited mines, as well as setting up of new washeries.
Right. Mr. Nath, such a pleasure to have you today on ET Now. Thank you so much for taking the time out.
Thank you very much for having me.
Thank you. Okay, that's the word coming in from the Steel Secretary, and quite a few, insights really coming in there. Everything from how global demand has been, more importantly, disinvestment of couple of the key companies and their non-key holdings. That is, really the takeaway that we've got, and the kind of monitorables and what they intend to do with the export duty as well. As of now, nothing. That's really the big takeaway. We'll take a very quick break on that note. When we come back, we'll discuss markets, get our charters back, and understand what to do in this falling market.